What has JPMorgan got to say about the gold price? Well, they're saying they've just raised their gold price forecast to $6,300 by the end of this year, by the end of 2026, and they say that $8,000 is on the table. UBS has built a bull case for $7,200. ANZ has raised its Q2 26 forecast to $5,800. The reason they give is sustained safe haven demand and constrained supply.
Rising gold price forecasts from major financial institutions are strengthening bullish sentiment in the precious metals market. Market commentator Clive Thompson notes that several global banks are significantly raising their projections for gold. Analysts at JPMorgan Chase have reportedly increased their forecast to around $6,300 per ounce by the end of 2026, while suggesting that $8,000 gold is now a realistic long-term scenario if safe haven demand continues to rise. Other institutions share similar optimism. UBS has outlined a bullish case for gold reaching $7,200, while ANZ Bank has raised its Q2 2026 forecast to about $5,800. The key drivers behind these projections include persistent geopolitical uncertainty, strong central bank buying, and limited new mine supply. With global investors increasingly seeking protection against inflation, currency weakness, and financial instability, analysts believe gold could remain in a powerful long-term bull market over the coming years. Now, we present the clips from Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
What's JPMorgan got to say about the gold price? Well, they're saying they've just raised their gold price forecast to $6,300 by the end of this year, by the end of 2026, and they say that $8,000 is on the table. UBS has built a bull case for $7,200. ANZ has raised its Q2 26 forecast to $5,800. The reason they give is sustained safe haven demand and constrained supply. But I don't want you to focus on the price targets or the forecasts. I want you to focus on why gold should be rising. Gold is rising because the system that was supposed to protect investors, the private credit funds, the open-ended real estate vehicles, and there's plenty of them defaulting at the moment, is failing. Gold is rising because the dollar is being debased, because inflation's coming, they're going to have to print money to bail out the system. Gold is rising because the central banks around the world have been buying gold at record rates for the last 3 years, and they're likely to continue doing so. And they're going to continue doing so because it's the one money that you can trust when you can't trust the paper. And let's just talk about silver. Well, silver closed on Friday at $82 per ounce. And we know that as far as silver is concerned, we are in a deficit. That means that the mined production of silver is less than what has to be consumed by industry. The consumption of silver has been rising every year. The production of silver has been falling, so we're now at less silver being produced than a decade ago, and we're at the highest amount of silver being consumed ever. The only way that extra silver, that difference, that deficit can be met is by recycling of silver, people taking in their old coins or their silver candlesticks and melting them down. So the gold-silver ratio at the moment is historically elevated at around 60 times. That means that silver's relatively cheap to gold. Now, historically, when the silver ratio has been this elevated, silver has subsequently performed when prices next had their leg up. So if gold does go to $6,000, which is widely forecast this year and beyond actually, then, and let's assume that the ratio of gold-silver resorts to its historical average, silver would be trading well over $100 compared with the $81 now. Now, what happens if gold goes to $8,000 and the gold-silver ratio goes to, let's say, 25, which would be a lot more normal than the current 60 we're at? I'll let you do the maths, but you can see where the silver price might well be going.
Precious metals are gaining momentum as analysts highlight powerful macroeconomic drivers behind the rally. Market commentator Clive Thompson notes that institutions such as JPMorgan Chase now forecast gold reaching around $6,300 by 2026, while $8,000 gold is increasingly discussed across the financial sector. Other banks, including UBS and ANZ Bank, have also raised their targets due to strong safe haven demand and limited supply. Beyond forecasts, the key drivers include currency debasement, rising inflation risks, and record central bank gold purchases. Meanwhile, silver demand continues to exceed mine production, creating a structural deficit. With the gold-silver ratio still historically high, analysts believe silver could outperform if gold's bullish trend continues. Let's get back to the interview.
Squeeze we expected in March kind of went away as the number of open interest went down very, very rapidly. Both shorts and longs closed their positions, and there was substantial rolling over of their positions into the May open interest here. So we've still got some open interest left in March, representing 6.5 million ounces. But in terms of registered silver, that's the silver which can be delivered. There's 81 million ounces in the CME warehouses. But coming up in May, there's open contracts for 384 million ounces. Now, that's not a different situation from what we saw back in March, where we had a huge number of a very large amount of open interest, which disappeared very rapidly as we approached the first delivery date. But the fact is, if we look at the amount of silver in the CME warehouses, it has been falling for months and months and months. And you can see it just here in less than a month, from the 18th of February through to the 5th of March. We're down another 7 million ounces, and eligible silver also was 279 down to 267. So silver is not only leaving the registered category, it's being taken out of CME warehouses and going somewhere, probably for production. It's also being taken out of the eligible category. That is to say, people who own the silver weren't necessarily intending to trade it on COMEX, so they're not turning it into registered. They're withdrawing it. Presumably they're withdrawing it because they have something to do with it, like using it in production. So that's your CME number. And now I'm going to tell you what's going on in Dubai and why the Iran war is affecting the prices of gold and silver in Dubai. It handles about 20% of all the world's gold global flows, around 1,200 tons per year. It's a refining center, so the raw bars, they're called doré bars from Africa and the Middle East. Now, the gold does not travel by land or by sea. That would be just too dangerous. So the only way that gold travels is by in the hold of a commercial passenger aircraft. All the gold coming out of Dubai will travel by air to wherever it's going. Obviously, road transport is completely uninsurable. Lots of flights in the Arab states have been suspended. The raw gold is still being refined and the inventory is building up, and people who've taken delivery, i.e. bought the refined gold or have consignments in transit, have suddenly found themselves holding metal that they can't ship. It's stuck. But the problem with that is that they're paying insurance fees, financing costs, that's the interest on the capital which is tied up in the unsold metal. They may have borrowed money from a bank, perhaps they borrowed from a private lender, who knows. That's probably quite likely, because I don't know if the banks would lend against gold in Dubai if you say, I'm going to have it delivered next week. And they're probably paying insurance premiums, and those insurance premiums are at the moment extremely high because of the fact that the gold is now in a conflict designated zone. So what are the people who've got this gold now doing? Because they don't want to, perhaps they don't want to absorb the escalating costs, at least not indefinitely. So what are they trying to do? They're trying to offload their gold to anybody who will buy it, and they're trying to offload it at a discount. The gold price in Dubai is being pushed down by major sellers, these are foreign companies which have bought the gold or try to ship it to London or to Asia or wherever else, and they can't do it. It's very, very costly to hang on to it. So what they're doing, they're trying to shift it to some other buyer, i.e. sell it. But of course, that's not as easily said as done. What it is doing is pushing down the gold price in Dubai, which means that if you want to buy it, and you could get into Dubai, you could go and buy it much cheaper. But the problem is you can't go to Dubai for obvious reasons. The airport is effectively closed. The bottom line is that there's an army of people who've got gold in transport who would otherwise be a normal holder of gold. They're going to move it and do whatever they do with it. And at this point in time, they're trying to get rid of it because it's costing them too much money to keep it where it is and they can't move it anywhere else.
Recent developments in the precious metals market highlight growing tension between paper contracts and physical supply. Data from the Chicago Mercantile Exchange shows silver inventories in registered warehouses declining for months, while open interest for upcoming delivery months still represents hundreds of millions of ounces. This imbalance has raised concerns among analysts about tightening physical availability. At the same time, global logistics disruptions are influencing gold markets. In major refining hubs such as Dubai, flight suspensions linked to regional tensions have slowed gold shipments. With bullion stuck in transit and insurance costs rising, some traders are reportedly selling metal at discounts to reduce financing pressure. These unusual conditions illustrate how geopolitical risks and supply chain disruptions can temporarily distort precious metals pricing worldwide. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.